Welcome back. Take a look at futures this morning on this, the final trading day of April. The Dow Industrial's down 7, the Nasdaq down about 29, and the S&P lower by 7.5. Interest rates, meanwhile, look like this ahead of the Federal Reserve's two-day policy meeting, which kicks off today. You've got the yield on the 10-year sitting at 4.62%. That is up 1.3 basis points. Investors are anticipating Jay Powell to remark on inflation, the economy, which will set the tone for potential rate cuts down the line. Whether it is this year, however, remains a debate. Joining me now is the Wall Street Journal's chief economics correspondent. He is author of Trillion Dollar Triage, Nick Timiraos. Nick, great to see you. Thank you so much for being here this morning.
Thanks for having me, Maria.
So what are you expecting from Jay Powell today, given that we've seen 3 straight months of inflation staying elevated and worries that, in fact, rate cuts may be off the table?
Yeah, that's right, Maria. I think the big question at the press conference tomorrow will be how Powell frames the inflation outlook. If you think back to the last meeting in March, the January inflation number had been hot. February hadn't been great. It hadn't been quite as bad as January. We didn't have the March number yet. And at the time, he said, this is a bump on the road. We've expected there to be bumps. The question now is this a bump or is it something more? The March number wasn't terrible, but it wasn't good either. And so I think the question now for the Fed is this still, bump on the road, or is it something more? And that's what we're going to find out, I think, from the chair. One outlook is, we're still kind of on this bumpy path down. The other outlook is that inflation is settling out closer to 3% than to 2% using the Fed's preferred target. And that would not be ideal here for the Fed.
Yeah, I spoke with Jim Grant, the founder of the Interest Rate Observer, and this was back in March, Nick, and he was really among the few out there when everybody was expecting rate cuts to throw the idea out there that, look, the Fed may do nothing. The Fed might even have to raise interest rates. Here's Jim Grant with me in March. I want to get your reaction. Watch this. You're not expecting a cut in rates anytime soon.
No, they might decide that 3-ish is fine.
They might 3% inflation.
Yes, it's concern over the inflation and to focus on financial stability as they would define it. But however, I think there's also a chance, Maria, this year that the Fed raises if they are confronted with an accelerating rate of inflation. They might feel they have no choice. And who's to say that the 3.2% thing couldn't go up? We have an $80 oil price, no longer 70.
Nick, I thought that was just stunning when he said that in March. Your new piece this morning in the Journal is titled, "The Fed to Signal It Has the Stomach to Keep Rates High for Longer," saying that firmer price pressures could lead longer-term rates to rise as investors continue paring back expectations of cuts. Tell us more about that and give us your reaction to Jim Grant.
Well, yeah, I mean, what Jim said in March certainly sounds a lot more plausible after the March inflation numbers came out. And so, the buzzword that you hear, Maria, from these Fed officials when they talk, sometimes they will say that they think policy is in a good place or that it's well positioned. And what they mean when they say that isn't so much that that everything's going to work out perfectly. It means that if things don't work out according to plan, if inflation's stronger than expected, or if the economy's weaker than they expect, it means they think they have a pretty easy plan of response. So right now, if inflation continues to run closer to 3% than to 2%, which is where it's been for the last few months, it's been running closer to 3%, they'll simply take out the interest rate cuts expected this year or early next year. What that'll do is it'll raise interest rates across the Treasury curve. That'll tighten financial conditions. It's really the same effect that you would get from an interest rate increase. So I don't see a lot of appetite right now from most Fed officials to raise interest rates. I think what it would take, Maria, to put actual interest rate increases back on the table, like Jim said, it would take some combination of inflation going higher, some nasty supply shock, oil prices going much higher. You'd need to see evidence of wages reaccelerating. That would cause some alarm at the Fed, or inflation expectations rising. And on those last two, wages reaccelerating, we're not seeing that yet, but there will be an employment cost index report at 8:30 this morning. And so that'll be an important sign of whether, wages continue to cool in line with what we've been seeing.
Yeah. So you write in your first graph of this piece, you write an ancient Chinese proverb that counsels do nothing and everything will be done could sum up the Federal Reserve's latest approach to interest rate policy. So, Nick, does that mean you're expecting nothing at this meeting, but perhaps the commentary becomes that much more important? What will Jay Powell say?
Yeah, in terms of policy action, I don't expect anything on interest rates at this meeting. There could be some changes on the balance sheet, but when it comes to the policy statement, I don't expect a lot of changes. And so that really, when they're not changing interest rates and they're not changing the policy statement, that puts all the attention on the press conference. How will Powell explain the inflation outlook? The interest rate outlook flows from that. And do they continue to talk about interest rate cuts? He'll be asked, I'm sure, where the bar is to raise interest rates again, and that could be a tricky question because you don't want to take anything off the table if you're a central banker right now. You've seen how this economy can surprise, but he doesn't want to put interest rate increases, front and center here because of what I said about how they think policy is in a good place. So that could be a little bit of an interesting moment.
Yeah, and let me ask you about the macro story yourself, Nick, because inflation is still elevated. Oil is one of the big issues there. With oil prices where it is, you have to believe that inflation stays elevated. But what are you watching specifically when you look at this macro story that the Fed is watching? Because remember, when you look at the GDP, we've gone from 4.9% in the third quarter of 2023 to 1.6% in the first quarter of this year, as oil is elevated at $82.80 a barrel, and obviously lots of other things are elevated in price within that CPI index.
Well, the big story really on the economy has just been resilience. Everybody's been expecting a slowdown and predicting a slowdown. 6 months from now, we'll be in a recession, and every 6 months, economists push out their forecast of a recession. You're right that headline GDP growth has slowed from around 5% to just below 2%. But if you look at real final sales to private domestic purchasers, that takes out inventories, trade, government spending. It's been for the last 3 quarters at 3.3%, 3.0%, and now 3.1%. I mean, that is just, there is momentum in this economy. And the Fed has said that's not a problem. They're no longer trying to slow down the economy so long as wages are coming down. So if it's not growth, what do you care about? It's inflation. And so right now I'm looking at the inflation numbers. Do we continue to get these 0.3 monthly increases that translate to 3% or higher inflation? Or do we get the 0.2s, which is what you're going to need to see for the interest rate conversation to get taken seriously again? I think they've put that on pause, perhaps indefinitely, until they see better numbers on inflation.
All right. We will leave it there, Nick. Great piece today, and thanks so much for joining me this morning. Good to see you.
Thank you, Maria.
Nick Timiraos, Wall Street Journal this morning.